Hello, everyone, and welcome to our outlook for 2026. We hope your year is off to a good start. Since 2022, we've heard endless calls for the U.S. economy to spiral into a recession, but it hasn't happened. We think there's one word that best describes our current economy this year, and it's resilient. And we don't anticipate a recession this year for a few reasons, starting with the current economic output. The most recent GDP print released in December showed a real GDP of 4.3%, driven by strong household balance sheets and solid consumer spending. Now, looking at stocks, yeah, we have to admit stocks are expensive right now, and they're going to continue to be volatile throughout 2026. We said expect volatility last year, and we saw a decline of 15% in just 4 days during the month of April. Now, keep in mind, in 1996, Alan Greenspan warned us of an expensive stock market, coining the phrase irrational exuberance. But the big decline didn't really come until March of 2000, even later in that year for large cap stocks. So it's difficult to time the market. Instead of trying to do that, we continue to recommend adjusting your equity allocation so that it's consistent with your risk tolerance, staying balanced and diversified. Now, as we move into the fourth year of this bull market, history is on our side. The S&P 500 historically has averaged 12% during the fourth year. It's happened, by the way, 7 times. 6 of those 7 years have been positive. Now, this slide illustrates the S&P 500 performance after the Fed cuts rates at or near record highs, which we're at right now. You can see from this middle line, the blue line, 1 year later, the returns have been just under 13%. So the bottom line is Jim and I are cautiously bullish on the market, and we think this year will require patience and faith and discipline. But a year from now, we are looking for returns, perhaps high single digits.
2026 is a midterm election year, which could have important implications for the stock market. Historically, midterm years have been challenging for equities. Since 1950, the S&P 500 has averaged a modest 4.6% gain during midterm years, with an average maximum drawdown of 17.5%, making it the most volatile and weakest performing year in the 4-year presidential cycle. However, once political uncertainty subsides, markets tend to rebound. Now moving to the fixed income market. Market pricing suggests that the Fed's rate cutting campaign could end by the second half of 2026 with the trough rate of around 3%. If market pricing is right, it's likely the 10-year Treasury yield will remain around 4%. It's unlikely that the Fed will cut rates to levels that would take the 10-year Treasury much lower. Thus, we think between a 3.75% to 4.25% 10-year Treasury yield range for 2026 is appropriate, at least for now. Upcoming likely dovish changes to the FOMC should help prevent the 10-year yield from drifting meaningfully higher. That's one key reason why our bond outlook is between neutral and positive. Thanks for watching our 2026 Outlook video. If you have any questions at all about this information, or if you'd like to discuss your own retirement picture, please don't hesitate to reach out to us at Platania Financial. We hope you have a great 2026 and take care. Please take a moment to review these important disclosures.